All right, so there are blood in the streets. Some multifamily deals are struggling. What do you do? Do you sit it out or do you double down and invest it all? The human brain has a crazy bias where it values losses twice as much as it values gains. This is a book called Thinking Fast and Slow. It's kind of a thick book, great book by the psychologist that talks about we value losses way too much. There's actually a huge bias to avoid any sort of losses. Now, I don't like losses. I know nobody likes losses, but in an equal world, if we have more gains than we have losses, we should be just fine. So, there can be a great opportunity and we can miss it because of fear. And this is where Warren Buffett talks a lot about psychology and temperament. He says the most valuable thing is just simply having a good temperament. He says be fearful when others are greedy and be greedy when others are fearful. So if you find yourself getting fearful, it might be a time to say, maybe I need to shift this and make a mindset change. We're going to talk about multifamily and why it could be a great opportunity now. I think you're going to love it. We got a great quote for you at the end. Let's jump in. All right, so my name is Bronson Hill. I'm the CEO of Bronson Equity. We do multifamily deals like this one over here. And we're also doing ATM machines, car washes, oil and gas, those type of things. And really, again, I'm not an investment advisor for you. This is just my opinions, but we're seeing multifamily now, right? We're seeing a situation where rates have risen from 3-4% was pretty common a couple years ago to now, for bridge debt, it's 8 to 12%. It's pretty rough, which has really affected valuations. However, we have incredible demand for the asset, right? We're way short. This article says we're 7.2 million housing units short. And so pricing has come down. Because why? Because valuations have come down because of the rates going higher. Just the cost of money has changed. So it's hurt some of our value. It's hurt some deals. We're seeing capital calls. We're seeing real challenges in multifamily. We talked about this too. That there's something that happens when someone's had a loss. They want to resist that. And so, however, multifamily is an inflation-hedged asset, and it could be potentially a great time to buy with the right deal. I'm going to get into why I think that is. But the second thing really is this is counterintuitive, and investor sentiment is down. What is investor sentiment? Investor sentiment is just how I feel about how things are going with investments, right? If I'm flush with cash and deals are going great and I've got all this money, I feel pretty good. I'm ready to invest in anything, right? And so investor sentiment is down. It used to be there were, a multifamily deal, we'd see 30 offers. And there'd be $1 million hard day one. Some people it'd be really, really hard to get a deal. Now you don't see that. Now brokers are calling you, hey, we got a deal, let's make this work, whatever. So the tide has kind of shifted and investor sentiment has changed. And again, if you've had a situation where you've lost money or there's been issues with operation, you might say, oh, this is bad, this is with multifamily. Multifamily equals bad. However, there could be opportunity there. And so it can feel, again, very counterintuitive. So I like the idea of being a contrarian, trying to find out of favor assets. Now, multifamily has gone from a hugely in favor asset to be a little bit out of favor, right? It's getting harder to the debt situation. We're seeing some deals start to get a little juicier, a little better. So it's something to start to consider when things change. So the market gives you what the market is going to give you. And it's important to make sure that you're actually looking at it from a very rational, intellectual way, not just from, okay, this has been my experience, right? So it's important to consider that. Another thing, when you're buying in a higher interest rate environment, your buying price is fixed, but the interest rate can be adjusted later if rates come down. So in a scenario, let's say you get a situation where there's cash flow, maybe the returns are a little bit lower than what they were a couple years ago, the projected returns, but you buy and you maybe have fixed rate debt and you're buying for a longer term and rates start to come down. Well, that can actually mean that your property is worth a lot more, or it actually really helps the valuation as well. Or maybe you can even refinance to a lower rate, right? So there's opportunities there that you can do. But again, the confused mind will say to wait. I've talked to a lot of investors, I have calls with investors all the time. And a lot of people are just, oh, I'm just going to wait. I'm not getting, and it's like, I really think it could be a mistake to not consider that maybe this is a better time. So again, it's less about just the asset, and it's also about what kind of opportunity are you seeing right now in that specific deal. So with current opportunities, what are the current opportunities right now? What we're seeing, this is a really unique strategy. We're seeing some of this to be really good. Obviously, everything fixed rate. A lot of people I know are doing fixed rate only now. They're doing bridge debt a couple years ago, which means it was a little more variable. But having fixed rate debt, a couple advantages. One, you know what your debt cost is going to be for the next 5 to 10 years, typically. And there is also a market, if you wanted to sell early, you could sell it at a premium if rates go higher, and you could say, I have this assumption deal. Somebody could come in and assume your loan, right? Which is awesome, right? They can basically come in and start paying it, and you basically get a premium. And we're seeing people that had the lower rates, 3 or 4%, they're getting a little bit of a premium. But I still think this is a great opportunity for investors, and we're seeing some opportunities to come in and buy a property with a 3 to 4% interest rate that's assumable, that we know we're going to have that rate for the next 7 or 8 years. Pretty attractive, right? We know we're going to be able to do well with it. So the question really comes down to of whether you sit it out or you invest it all, right? Do you fold your hand, or do you push all your chips in there? Well, I think it really, the question is compared to what, right? Well, compared to what? That's a great question to ask. If I don't do this, what am I going to do instead? And a lot of people, and you may be considering, I'll just sit and I'll wait and I'll put it in the bank, I'll put it in a high yield savings account, I'll put it somewhere else. But the challenge is inflation is going to get you. There could be opportunities. You look back and say, man, if I just try to get a little more involved in some of this stuff, I could have done very, very well. So, there's a few huge benefits of multifamily. One, it is an inflation hedge. It's not super, just even all the way, but it is over the long term. It is a great inflation hedge, which rents and inflation really go hand in hand. Not really, cash doesn't do it. Cash is going to lose value, and stocks typically don't really keep up with the pace of inflation. Somebody could argue, say they do, but it's just so volatile. There's so much volatility there. You have a lot of tax benefits. You also have appreciation just over time as you're able to increase the rent. So in summary here, great time to consider it in the right scenario, getting more into multifamily. Again, just be thinking too, in any of your investments, am I doing just simply what the herd is doing? Because really big money is not made when you follow the herd. Usually when the herd is getting into it and everything's in favor, it's a time to really start being cautious and maybe start trimming down your positions or things like that. So it's just something to consider, that maybe you can have a second look at multifamily right now. This is a great quote. It says, "Now is always the hardest time to invest." Bernard Baruch was a famous financier a couple hundred years ago. Super bright guy. And so it's always the hardest. Just make the decision. Okay, I'm going to invest now. Right? It's always the hardest time because there's always other things you can do with the money. It's been said that the wealthy invest first and they live on what's left over. The middle class will spend first and invest what's left over. So which are you doing? Are you investing first? Are you planning to invest and really have more cash flow over time? I hope you are. If you haven't checked out my book, I've got this new book out called Fire Yourself, which is now an Amazon bestseller. And it's replace your working income with passive income in 3 years or less. You should check it out. Amazon, also in the link below. And then I want you to check out this video. This is called The New Rules of Investing. There's some new rules, things that I came up with. I want you to check that out. If you haven't joined our investment club, you're not hearing about our great deals. So multifamily, oil and gas, ATM machines, and car washes, other types of deals. You can check that out in the link below. We'd love to set up a call with you. Thanks for taking the time to educate yourself. Look forward to seeing you on the next video.